So this video is for the financial units of business studies, and it's looking at stock turnover. Now, all stock turnover is just looking at how efficient a company is to actually turn over the stock. So it literally looks at the speed as to which a company can sell its inventory, because the faster they are at selling it, the more revenue they can generate. Now, in terms of judging that performance, they'll have to compare it with something. Now, in usual case studies, what you'll compare it with is maybe previous years. So maybe they'll have two different years, and you'll have to calculate the stock turnover for both years and see how the business has progressed. Or they might do it on the industry average. So they'll give you, or you'll have to calculate what the industry average is, and then you'll have to compare it with this specific company. Now, there's two methods of calculating it. Method one looks at just the number of times stock is turned over in a year, and that is your cost of goods sold divided by your average stock. And then you got your method two, which is based on days. So it's your average stock divided by your cost of goods sold. So that's flipped, but you times it by 365 to get your days. Now, you'll have to just pay special attention to the question in the exam if you do get questioned on if you do get asked about stock turnover. If the question has a specific focus, so for example times or in days, then just look out for that. However, if the question is quite open, then the mark scheme will allow both methods to be used. Now, to put this into practice, I found a past paper with a stock turnover question. The dates are a bit random. It's not that old, the paper. It's only from a few years ago, but they've got the dates of 1965 and 1975. Now, they're giving you the average stock of 29 million and 54 million, but they don't actually give you the cost of goods sold. So you have to calculate that. So it creates a new element to this question and makes it a little bit more challenging. Now, in order to do this, what you need to look at is the gross profit and your sales revenue, because we know that in order to calculate your gross profit, you do your sales revenue minus your cost of goods sold. So therefore, we just need to reverse that formula. So now we've got our cost of goods sold. We've done 113 minus 35, which has given us 78 million. And then our 194 minus 56, which gives us 138 million. And if you want to just make sure of that, then just go back to the normal formula of 113 minus 78, which will give you a gross profit of 35, and 194 minus 138, which will give you a gross profit of 56. So now we've got that, what we're going to do is we're going to use both methods in calculating. So the first method, method one, which is looking at your cost of goods sold divided by your average stock. So we've got our cost of goods sold of 78 million, obviously divided by 29 million, and what we've got is 2.69 times per year. Then for 1975, we've got our, again, cost of goods sold, which is 138 million divided by 54 million, and we get 2.56 times per year. So for the second method, we're doing it based on days. So this time we change the formula, and we do our average stock divided by our cost of goods sold times by 365 to get us days. And we can see that in 1965 they turned over their stock every 135.71 days. For 1975 they did it every 142.83 days. So that tells us that in 1965 they had a better stock turnover than in 1975, because in 1965 they turned over more stock and at a faster, in terms of they did it faster as well within the year. So they had to do it every 135, just over every 135 days, rather than 1975 where it was actually longer and it was 142, just over. Now, when considering stock and considering stock turnover, and maybe you've got a question based on all businesses, you have to just be very careful with comparing stock turnover as a performance measure, as a financial performance measure across different industries, because they're very different. If you've got, for example, some businesses that expect to have a high stock turnover, such as supermarkets, then obviously, yes, you can look at it from that point of view. But if you compare that to other sectors and other industries, it's not really a fair comparison. So, for example, if you've got stock turnover of a supermarket and it's much better than of a car dealership, that's kind of common sense. It'd be expected. We wouldn't expect a luxury car dealership to turn over their stock anywhere near as fast as, for example, a supermarket. A supermarket, the whole idea of a supermarket is that they have as much stock on the shelves as possible, because they expect it to turn over at a very, very fast rate. And in fact, Lidl is one example of that, because Lidl's business model has been definitely based on that stock turnover, and that's what's really helped it. So I've just found this article, and it says Lidl favours everyday items that shoppers buy often. So the assortment is limited to the fastest moving items, which drives gross profit dollars. So higher velocity items mean less money tied up in inventory. In a visit to one of the new stores, he said he noticed the focus was on everyday items such as cereal, juice and produce, rather than niche or specialty products. So the whole idea of Lidl's, I suppose, operations objectives is to find that stock which is expected to move at a much faster rate. Now, some key advantages of having a high inventory turnover, such as the likes of Lidl. For number one, think about income. So if we think about a high sale of stock, therefore the firm's going to generate a higher level of revenue. The faster the stock turnover is, the faster the revenue is. But again, if we think about supermarket stock, it might be low in price. So they have to turn over at a very fast pace to try and generate as much revenue as possible. Also, if you think about bargaining power, so if you think about these companies such as Lidl that do have a high stock turnover, it means they're also purchasing greater volume of stock and on a regular basis as well. And this might give the firm more, greater negotiating power, because they're able to again buy those large volumes of stocks and maybe even get purchasing economies of scale. And again, if we consider the supermarket industry and we think about some of the products that they sell, quite a lot of their products are quite, perishable. They will expire quite quickly. Or if we think about clothes retailers, which really depend on fashion and trends, their life cycle is quite short. So again, by having a really fast stock turnover, it means that they avoid such waste. So it's making sure that they sell the stock before it expires, and they sell the stock before it goes out of fashion. And also it can help, and as it says within this article, it can help also reduce storage costs, because the longer you store the product, the higher the cost of storage for that unit will be. Now, in terms of how to improve your inventory turnover, some of the ways you can do so is by understanding what the market requires. So market research. It's essential to understand the market demands, because if you understand what the market wants, then you can make sure that you can meet that need, and therefore you will sell. Also, having a stock management, a sophisticated stock management system that you've really planned it out. You're analysing the performance of your existing stock. You might do this via Boston Matrix and looking at your current product portfolio. Which products do actually have a fast stock turnover? Well, if that's the case, then purchase that stock. The ones that have a slower stock turnover, maybe actually completely remove that from your product portfolio. It also, another way of improving it is lean inventory, so avoiding high inventory levels, because that can also help to avoid potential waste. So maybe actually considering lean techniques as just in time. And again, related to market research, you could maybe look at marketing as well. How do you generate high sales? Well, you have to think about different elements of your marketing mix. Making sure that you are promoting effectively, making sure that you are placed in the best locations, making sure that your prices are attractive to customers, and so on.